Welcome to America's Commercial Real Estate Show, your source for intel, forecasts, and strategies. Hello, I'm Michael Ball. Thank you for being with us. This segment is brought to you by my company, Bull Realty. For specialized and customized asset and occupancy solutions, visit bullrealty.com or give me a call. Well, today we're talking about the office sector, and what a great sector. And with everything going on with the economy, all the great news and some hiccups, people are curious. What is the office market doing? What should we expect moving forward? We're going to share some tips for investments. We're going to share some tips for users. We're going to share some strategies for site location activities. So please welcome my first guest. It's Jim Costello. He's Senior VP with RC Analytics, and he's joining us on Skype. Jim, thanks for being with us.
Thanks for having me here today.
Jim, one of the things that is in the news today that people are probably curious about is the Chrysler building there in New York, right? What's going on? Why are we selling this icon?
Yeah, I've got a little model of it right here from Bob here, his collection. It's interesting that buildings like this don't come up for sale all that often. It's an iconic building, but there's a lot of questions of what happens next. While it's an iconic building, it is a little bit older, and there is some new construction coming into Manhattan. And so the process of underwriting, I think a lot of people are going to be sharpening their pencils trying to figure out what they might pay for it. It's got a complicated ground lease structure as well, with the payments for the ground lease going up sharply in 2019. And so that's going to change how people think about it as well. But there's not too many of these things that come up. And we have since January 2017, only 19 800,000 square foot plus buildings in Manhattan have come up for sale. So it's a 2-year period, effectively. And in that time period, there were the winners who have been participating in purchases of those assets have totaled about 30 different teams. It means a lot of capital going into joint ventures because they all want a piece of this market, but it's hard to access. So there's a lot to balance out in this transaction.
Yeah. How old is that building, and how long is that land lease? Do you know?
The building is 90 years old, okay. Looking pretty good for 90. And the land lease now expires, to my understanding, off sometime after I'm dead.
whenever that is. Okay. Well, you be careful out there on the streets today, okay? Because we want that land lease to last. Well, that certainly does complicate it. We're closing a sale now involving part of the property in a land lease, and it makes it more fun for us as brokers. Well, another thing that seems to be thought of by the real estate industry when it comes to office properties is that the central business district is where it's all happening, with the Chrysler building in the large cities in town. But what do you see when you really look into the numbers?
Yeah, and that dichotomy, looking at CBD office space versus suburban space, early in this cycle, everybody and their brother, when they're investing, they wanted to be in the CBD locations. There was this thought that let's buy office buildings in the CBDs. That's where the millennials want to live and work. And that's almost 10 years ago at this point, where that story was so starting to take hold. You add 10 years to what kids in their 20s were back then. They're in their 30s now. They're getting older. They're pairing up, having kids, moving to the suburbs, and combine that with the fact that to the extent that we've built housing in the last decade, it's mostly been in suburban locations. So we're starting to see a shift there on the demographics of the labor force into more suburban locations. And deal volume now is starting to follow for the suburban office market. Last couple of years, the suburban office market, normally suburban and CBD volume are pretty close to each other. It's a growing divergence between the two. Suburban office volumes, we don't have final figures in for 2018 yet, but probably somewhere 78 to 80 billion for transaction activity versus something like 50, 52 billion for CBD locations. So that's a healthy difference.
That's interesting. And as far as the volume of actual larger, nicer buildings, there's probably a higher percentage of those buildings in the CBD, right?
Well, there is that. You're not going to have too many iconic buildings in a lot of suburban locations. A lot of suburban locations are more utilitarian, but also that's changing in terms of what we mean by suburbs. The geography is one thing, but some of the newer developments in suburban locations have a lot more amenity structures. Developers building urban features within a suburban area. Buildings in suburban areas that have walkability and access to transit are seeing much stronger price appreciation, but prices well above the 2007 peak levels at this point, versus other suburban office buildings that are struggling a little bit to come back to that previous peak.
Yeah. So is suburban office potentially in some markets where the opportunity lies?
I think so, in the sense also of the yield opportunity. So you've got two factors, I think, that are driving capital to look at opportunities in suburban locations. There's that demographic wave issue. You have to chase where the workers are going, because that's where firms will go. But also, average cap rates are 100, 150 basis points higher in suburban locations. And that hunger for yield worldwide can drive investors to look for opportunities in those locations.
Yeah, that makes sense. And so what did you see for cap rate trends in 2018 as you're wrapping up numbers there?
What's interesting, I get that question a lot. People are worried about what's been happening with interest rates and will it translate through to higher cap rates. And so far there's no evidence of that. Now, the interest rates themselves have been very volatile. They went up in the fourth quarter, hit a peak around 2.2%, and then they plummeted down 2.6, flirting with 2.5 the other day. So cap rates, it's not like trading a bushel of soybeans on the options exchange. It's something that the deals take a long time to close. The underwriting is a very thoughtful process, and so cap rates just haven't moved yet in response to that turmoil. And so they've been somewhat flat, and people, I think, are taking a little bit of a wait-and-see attitude.
Interesting. And it seems like we saw a lot of medical office buildings in our shop, and it seems like traditionally we see the cap rates being a little bit higher returns for investors on the medical versus the regular office. Is some of that maybe based because there was so much CBD property selling at some lower cap rate sales? What are you seeing today for office building cap rates versus medical office?
Well, in theory, you should always have a higher cap rate for a property with more management issues than fewer management issues. You're going to try and compensate somebody for some of the risk involved in the higher capex issues, perhaps. But the medical office, I would imagine that there's probably we have definitely seen a faster pace of growth from medical office sales. That's something that has been helping to lift the suburban office sales. And part of that is people trying to get into the demographic wave of more demand for medical office, period, as the baby boomers age. And so that can provide a countervailing influence to maybe compress cap rates for medical office relative to the market overall.
So would you expect those cap rates then between regular office, medical office in 2019 to sort of level out then? Similar?
If that force of the argument around the demographic wave is stronger, I'd expect it to narrow.
Okay. What do you expect for cap rates in 2019? I mean, you said it, interest rates have been going up. What do you expect now, especially with some of the recent turmoil in the stock market? We have a government shutdown. What would be your guess of cap rates in 2019 trend-wise for office?
I mean, here's the thing. There is more uncertainty today. Every day the government stays closed, the amount of uncertainty increases. It creates challenges in the financial markets. It creates challenges in real estate for financing projects in some cases. And so that uncertainty has two effects. When there's uncertainty in the financial markets, people flock to safe assets, such as the 10-year Treasury, which might help to bring that down a bit. The other thing that people look at is the safety of real estate. because when you're buying an office building, you know what you're getting. You're getting an income stream tied to a certain collection of tenants, and you can look into their credit rating. So that might help if you have more turmoil in the stock markets, you have more uncertainty coming from DC. It may have a perverse impact in terms of making more money look at real estate. Right. Frankly, I think it'd be better if more money looked at real estate, not because of uncertainty, but because of thoughts of stability in our public policy, stability in the economy, expectations for growth. But we may have capital looking at the real estate sector, for in some respects the wrong reasons this year.
Right. And when you think about the shutdown, its impact on the office market, someone might think it's going to be just around maybe DC or areas like that. But you have a lot of companies that do work with the government that could be impacted here, right?
Yeah, the federal government is not justified, frankly. But think about the follow-on effects. Right now, they're talking about this upcoming Friday being the first day when some of the federal workers don't get paid. That has follow-on effects to every little diner and retail establishments and landlord who's not getting their rent checks. That's going to take a bite out of the economy and lead to some uncertainty in these areas. And then the longer it stays in place, that's going to impact the office market. To some of those companies face some retrenchment as GSA leases maybe come up, and maybe then there's some uncertainty about what happens next. Financing projects is going to be a problem for some sectors. FHFA stuff and the apartment sector is going to have challenges. So the longer we have this uncertainty hanging over there, the more damage it's going to do to the real economy.
Yeah. Yeah, we've got a deal that's been stalled because it needs SBA as a company buying a building, and they're getting the SBA financing, and it's kind of on hold, and that stuff starts to trickle. I want to get your idea. I know if I asked you this, I don't know if I understand your estimate on cap rates for 2019 for office. So what was the kind of the trend in 18 for cap rates number-wise for office, and do you expect that to remain flat in 19? I mean, what do you foresee?
Yeah, cap rates were flat in 2018. In 2019, the thought at the moment is that the Fed maybe will not be doing as many raises of the Fed funds rate, that we might be at the end of that. There may not be the pressure on the longer end of the yield curve. In fact, inflation expectations in the last month and a half have really tanked. We had higher inflation expectations into October, November, but they've tanked of late. And if you have a higher pace of inflation, that's what drives investors to seek a higher return on the long end of the yield curve to kind of cover themselves for those risks. So if inflation expectations are tanking, I'm not going to see the same sort of upward pressure on interest rates, and therefore you're not going to see the same upward pressure on cap rates. We may be in for another flat year on cap rates.
Okay, and that's interesting. What are some of the other aspects of the economy that could impact the office sector? We have a lot of co-working growth, especially there in New York and in other cities. We have people are supposed to be working at home these days and working home more from home. Any of these aspects you think could impact office sector moving forward?
Two things to digest there. First, the other risks broadly. There are other risks, and then the co-working. Let's start with the co-working. WeWork is trying to change their label, become something else. We Company, I think was the name, to be more than just office use. And this is coming after SoftBank is not going to come through with as much money as they had initially promised. So there's a lot of people kind of looking at that with a bit of schadenfreude, thinking that they've had their comeuppance. We'll see where that goes. But it's certainly the case that for a lot of smaller firms, it doesn't make sense to get their own 5,000 square foot or smaller office at this point. Whether it's WeWork or somebody else who follows that business model. I think that kind of pooled resource of a co-working location is a model that in some way, shape, or form that will continue to live on. Now, uncertainty broadly, there are other things besides the government shutdown. And again, it goes to kind of policy coming out of DC. The trade war stuff that we've been talking about with China, that is up in the air as well. And what happens next there. And what's distressing about all of this is that none of it's necessary. It is government policy generating the uncertainty. You remove those sources of uncertainty, and suddenly you could have inflation expectations picking up. You could have businesses looking for productive sources of growth. The fundamentals of the economy, absent the uncertainty, I think are okay.
Jim, what do you think about the investor interest in the office sector moving forward now and into 2019? When you compare it to other sectors, it seems like multifamily is still a darling cycle. Everyone loves it. Everyone loves industrial. Where does office come into play today, risk-wise and appetite-wise for investors?
I mean, again, we don't have our final 2018 figures in yet, but it looks like the office sector in total will have a down year for 2018 with less deal volume than in 2017. It's the only major property sector where that's going to be the case. Part of the issue is that the other major property sectors were chock full of these entity-level transactions in 2018, where somebody's buying not just a property, but buying a whole company at a time so that they can get at the assets that the company owns. And so that would be like the Westfield acquisition in the retail sector or DCT in the industrial sector. Those multi-billion-dollar deals, until December of 2018, we didn't see any of those for the office sector. We suddenly saw two of them in the office sector in December. It's Brookfield and Forest City. They had some office space, and Select Income REIT and buying a government REIT. That had an impact as well. But still, even with that burst of entry-level transactions in December, deal volume for the year still looks like it's going to be down. So the comparison to other property sectors has just been a little bit lighter. Although I think part of that is just that dichotomy between CBD office and suburban office. All office stuff is not the same, and the suburban office market is relatively stronger than the CBD market. Again, traditionally the numbers are pretty close between CBD and suburban in the split, and there's almost a $30 billion gap between the two for 2018.
Yeah, that's interesting. Well, good luck with the Chrysler building there. Your model sells there on your table.
And
that's
Jim, not for sale. It's not mine.
You're keeping that model, right? All right, Jim, thanks for joining us, sir. Appreciate it. Thank you.
All right, take care.
All right, and if you'd like more information from Jim, check out their website. It's rcanalytics.com, and we will have more for you right after this break. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.